Let's talk about the income statement, also sometimes called the profit and loss, P&L, or the operating statement. And the point being that owners and other stakeholders need periodic information about how the company is doing in terms of profit. That's what we're trying to communicate. That's the part of the story that we're telling with the income statement. So we're matching revenue to expenses for the period so you can see what profit is left over. And here's an example of an income statement. Let's walk through the major line items of this sample income statement. And just real quickly before I start, I mentioned something called the matching principle. It's an important concept to keep in mind about the income statement. The income statement is done for a specific period of time, and you need to match the revenues that were generated in that period to the expenses that were incurred at the same or over the same period of time, which are actually what it took you to produce the stuff that you sold in that period. So the first line of our financial statement here, the income statement, is sales, which is the total amount collectible from customers during the period for the delivery or the sale of goods and service, regardless of the way it's paid or whether or not it's been collected, because accounts receivable are also included in the amount of revenue that you're looking at here, not just when things are paid in cash. So revenue is not affected as a concept whether you're being paid cash during the period or whether you collect later in a different period. And notice too that on the right-hand side of this statement, we have a column that's showing you the percent of your sales that relates each of the line items as a percentage of those sales. So the next line, COGS, or cost of goods sold, is actually 79.2% of sales, is what that's telling you. And actually, let's go ahead and talk about what's included in that line item, COGS. Because COGS are expenses, and including labor and materials, and in this case, you see in the box, depreciation. Expenses that are directly tied to units of products sold. And COGS really represents inventory that you're selling in the period. That's what it really is. And that's why in the pop-up, you can back into your COGS number by looking at cost of goods manufactured and seeing what you actually sold out of what was available to sell. And in this example, you'll notice that depreciation and maintenance are being allocated to COGS as well. Although many times companies show these costs separately after the gross profit line item. But depreciation is an expense for the tangible fixed assets that you use to make the stuff that you sold. Things like plants, equipment, tools, things like that. Those assets are expensed over time, not all at once, as they are used, and their cost is matched broadly to the revenue earned in that period. And that makes sense. You wouldn't want to hit your income statement all at once with the cost of a new $10 million plant that you're going to use over 10 or 20 years. You'd expense it slowly over time as you generate revenue from the things you're producing in that plant. And gross profit is a subtotal, and what's left over after direct expenses or COGS are taken out of revenue. And this is really what's left over to cover overhead, interest, taxes, and hopefully have some profit left over after it's all said and done. And you see some of the next lines: marketing, research and development, and then general and administrative expenses as well. And then we get another subtotal, income from operations. And this is the amount of operating profit left over before interest, extraordinary expenses, and taxes are taken out. And this is a key number, and it's called operating profit because it tells stakeholders, remember, as part of the story that you're telling about this company, about what is going on at the company from an operating standpoint. And interest, extraordinary items, and taxes are not really in the direct control of the management and day-to-day operations of the company. So our operating profit is often shown as a separate line item. and gets a lot of attention from stakeholders about how well the business is being managed. Then you see the interest income and expense line. This is interest on loans that we've taken, or it could be money that we make from investments. Then income taxes are subtracted again after business expenses are taken out. And you're left with net profit, or the bottom line, which in this case, the net margin is 9.1%. So when you hear that term margin, generally people are talking about that percent, profit as a percent of the sales, whether it's gross margin, operating margin, or net margin. It's that percent on the right-hand side of the screen. And net income after tax can go to one of two places broadly. Retained earnings on the balance sheet, which is money that you're putting back into the company, or it can go out of the company as dividends or distributions to shareholders, the owners of the company. And remember, as we talked about before, profit is not always the same thing as cash. And profits subtract, for instance, depreciation that we talked about, but that's a non-cash expense. So the point is, profit, again, is not always the same as cash.